million into each of the companies that we participate in financially. We like to do that in syndication. So really you're looking, which just means with other investors, so really you're looking for opportunities where a company might need, I don't know, $10 to $25 million or so, and that's not what TAG was looking for at the time.
Basil, how about you? Any comment? Did she talk to you, or did Greg talk to you?
I didn't talk to Greg, but I think...
Hey, Greg, how come you didn't talk to Basil?
Well, I'll tell you the answer. I think Greg knows the answer. Financing is kind of a matching game. And when we were prepping for this panel, we were talking about how we might be able to convey to the audience that really what you're doing when you're an entrepreneur out trying to raise capital is you're trying to find the right investors for your company. And as Mike said, TAGA wasn't a perfect fit for his fund because he's a larger fund that has to invest more capital than TAGA needed. So that wasn't a fit. And Amielle probably knew that and probably didn't approach Mike for that reason. I'm a very active investor. When I invest, I always want to get very involved with the company. I'm always on the board. I'm usually the chairman. And by the time that I'd heard Amielle's pitch, Greg Smith had already taken that job of being that lead investor, that very active chairman or director. And that was the biggest reason that I didn't have the inclination to engage. I was also busy at that time. But it's a good example, I think, of the kinds of things that entrepreneurs should be doing when they're looking for capital, is finding the right match. Amielle had good instincts. She went to find people in Seattle who understood her particular space, and then she pursued them relentlessly, which I wish she wouldn't say because I just know my phone's going to be ringing over and over again. But that is part of the process.
But still want to be polite about it. Yeah.
And as I said earlier, any of you, if you have any questions, anytime, just put up your hand, and we can interrupt the flow here. We don't want to hold questions till the end necessarily. So Amielle, instead of me asking myself a question, maybe you could answer it for me. Why didn't I invest? Why didn't the What If Fund? We've invested in 50 companies. We do a deal a month, roughly, small amounts, $100,000 at a pop. How come we didn't invest? I think, Greg, you asked us, didn't you? Yeah. Maybe only 2? Why do you think we didn't invest? Because we should have, quite frankly, because our model would say that we do, but something fell through the cracks, and I'm curious as to what it could have been.
Well, I guess I'll speak for you.
Please.
Feel free to disagree, of course. I think by the time we started to talk about this seriously was actually 2 weeks ago on the call we had concerning this very panel. Mike and I afterwards exchanged some emails about the possibility of investing, and I guess that's one of those important signs. We didn't go through any sort of qualification process, but we figured out very quickly that the timing wasn't right, mostly because, Mike, you're not investing in companies at the moment.
Well, right now,
right
but
now,
at the time
yes.
that Greg was approaching us, we did have the ability to do it. See, because our model is, unlike Basil's, we're a little more passive, but I like guys like Basil or other entrepreneurs to be in a deal. So with this What If Fund that I put together, we basically co-invest. We'll only go into a deal if there are others in there, especially ones that know what they're doing. So if you found the guy in Seattle and he invested because he likes and understands your company, we should have been there too.
I
but
agree.
Somewhere something fell through the cracks. But it sounds like you were at your limit in terms of what you needed. I mean, in case there's never a limit, right? You'd always take more, wouldn't you?
Within
there was
reason.
And she would,
yes.
because she asked me to write a check after we had this discussion 2 weeks ago, and we still might.
Okay.
We still might.
All right.
I want to
I
turn
brought a
the
subscription agreement.
Great. And I've thought one for you too.
Okay.
See, that's good characteristic.
Yeah.
Great. So you've seen an example of an entrepreneurial style. Let's talk a little bit more about investing styles. And maybe Basil, you've got a certain style for investing. Tell us about it. How do you work? I
sold my company that I started after I was in grad school and have been an investor ever since. So I'm coming up to sort of my second decade of doing this. And I'm an engineer, so I have this genetic predisposition to measure things. And when I first started to invest, I tried a number of different things and tracked the results. And what I found was that if I invested in things where I wasn't involved, I could do just a little bit worse than an index. But the things where I made money were the things where I was actively helping the company to grow, helping to raise more financing, where I was actively involved. And in my particular case, the numbers were so compelling that I actually had to build discipline around not making passive investments, because for some reason it doesn't work for me. And so what I do is I probably only make one investment a year, because I'll typically be involved with the company for 4 or 5 years. Once I've joined the board, it's almost certainly a 3 or 4 year stint, because I don't like to leave anything that's not fairly finished. And because I'm active, I can't really manage more than 5 or 6 companies in my portfolio. So it sort of works out to about 1 a year. So I'm a very rifle shot investor. And what I worry about is that I'm not sufficiently diversified. I don't have enough investments in my portfolio, so I'm likely to have volatile results. Mike, who I often co-invest with, has almost the exact opposite strategy. I've invested usually in 5 or 6 companies. Mike's invested in 50 companies, but yet we're very compatible as co-investors, even though our styles are very different.
Yeah, I do take a bit of the shotgun approach, I must confess. Because, if you see some birds flying by, you might hit one of them. And it's funny because the BC government people, and I've always had these debates with them about tax credits because I use those tax credits a lot. They call my approach the spray and pray approach. But, it's working.
Seed and weed is another thing.
What's your approach?
Seed and weed.
Seed and weed, yeah, exactly, yeah. Okay, so Basil, I wanted just before were you going to say something? Were you pointing at my notes? Question. Yeah, great, yep. As I said, interrupt us at any time.
Could you tell me what is your take on buyout options?
What is our take on buyout options?
Yes.
Can you explain what you mean by a buyout option?
Are they used in practice or not?
Used by who? By the investors?
By the investors, yes.
Sort of like you mean like a put option to put back to management to get out of the investment?
Exactly.
Basil, is that in your exit strategies book? Is that a viable exit strategy?
I've never used one of those.
No, I think generally speaking, the investments we're involved with don't get terribly fancy about how you get your money out. I think it's not really possible to engineer an exit at the time you're making an investment, so we tend not to have anything in our agreements around the structure of the eventual exit, because it's the buyer ultimately that's going to dictate the form of the transaction. You just have to decide whether you like what's on offer or not.
You're thinking like management buyouts, that kind of thing?
Yeah.
Pretty hard for tech companies, right? I mean, tech companies are growing, so it's the old hockey stick curve, and they're always starved for cash, so it's kind of difficult to do. Have any of you had any?
Well, it was certainly one of the big trends in the last several years that venture capital-backed companies were exiting to companies that were essentially, or they were exiting to private equity firms that were putting up a lot more money and taking over ownership of the majority of the company. So it's something that was there just because there was a lot of debt available. Now that debt isn't available to make that work, it's not so common.
Okay.
It'll probably come back again when debt's cheap.
Let's talk a little bit about the current climate for investing. The last year has been pretty tough on a lot of us. Yet, Amielle, you raised money. I just did a little survey, just an ad hoc thing with some of the companies that I've worked with, and I talked to 50 companies in the last 2 weeks. And these 50 companies collectively raised over $100 million, which was encouraging. And what was interesting is they raised about the same amount each year for the last 3 years. I didn't see a dip in 2008 or earlier 2009, which was kind of interesting. So that tells me there are investors out there. There's money in the sidelines. One of the challenges that we, as, say, angel investors have, and this came up in the Toronto summit last week, is how do we get you hear of high net worth individuals, accredited investors that are so-called angels that have over $1 million in their jeans to put into a company. But what about the other HNW investors, what I call the hidden net worth investors, those that are not quite at $1 million, but that could speculate a little bit, could put their money into some companies, and we're seeing more and more of creative mechanisms for getting these people that have been traditionally sitting on the sidelines coming out to invest in companies. I'd like to just ask Basil and Mike if they've seen any, what their observation is. And Basil, you wanted to get some